It's 2026, so you know what that means. We've got to go back through 2025 to take a look in the rear view mirror. Let's check it out. So I don't want to spend a ton of time showing boring charts, but it is helpful to look at some of these. On this first slide, we see the green line is days to sell, median days to sale, and where this is the normal seasonal pattern where we have a hotter markets in the spring and summer and it slows down in the winter. So you can see the number of days to sale is dipped into the 20s here in the spring of 24, back up over 50, between 50 and 60 in the fall and winter. And the list price, the median list price was kind of steady during this time frame. Second slide, kind of the same representation, slightly different data. We're using months of inventory in the blue line. And again, normal seasonal pattern, and this is over the last 2 years. And the last one here, was probably the most concerning to me, is this includes the close price to list price ratio, where the list price is this blue line up here, and then the close price is the green line. You can see this has kind of been drifting lower over the last 2 years, which means more and more concessions or sellers having to give up more to get the sale achieved. And lastly here, I'll bring up the Sun stats because this is always the last to update. This is still showing November, but it does have the year-over-year change for closed sales up 14%, median sale price 2.8%, up 2.8% from a year ago. And this portion here, the median list to sale, listed as 96 days to do that, down from 111 days a year earlier. And then new listings are down 18%. So what about 2026, you ask? Well, the U.S. economy is in kind of a complex phase where we're showing strong GDP growth and a resilient job market with low unemployment and solid job creation, but we're facing this persistent concerns about overinflation and high costs, which is leading to mixed consumer sentiment and worries about future stability, especially as AI investment booms alongside potential economic slowdowns and trade uncertainties. So key indicators are pointing to a healthy but evolving picture with high productivity and consumer spending, which is driving expansion, while inflation moderates, but wages still struggle to keep pace with price increases. So when we zoom out and we're looking at 2026, the national economy is sending mixed but important signals. And here is how that's going to play out locally in North Central Florida. On paper, the economy is strong with solid growth and low unemployment and big investment in areas like AI and infrastructure, but for a lot of households, it doesn't feel strong. And because prices are still high and wages haven't fully caught up. And so what that means here is this: we're likely to stay in a selective, price-sensitive market. Well-located and well-priced homes will continue to move well, especially for buyers relocating here for jobs, lifestyle, or cost of living relief, while anything overpriced is going to sit. So going on into 2026, opportunity won't come from timing the perfect rate cut, or we may not need to. It'll come from strategy, pricing, and just knowing what pocket of the market that you're in. Markets like this reward preparation and not guesswork. So whether you're buying, selling, or just planning ahead, teaming up with a knowledgeable local real estate professional helps you avoid costly mistakes and spot opportunities others miss. If you want clarity, that's where the conversation begins. Give me a call, 352-870-5700. I hope to talk to you soon.